Time now for our hot picks. Our next guest focusing on the pharma sector, and here to give us his stock picks is Sel Hardy, Senior Equity Research Analyst at CFRA. Sel, thanks for joining us.
Thank you for having me.
All right. First up, let's get right into these. Eli Lilly, you're liking right now. What's so appealing?
Yes, so we have a buy opinion on shares of Eli Lilly with a price target of $964. We see Eli Lilly as well positioned to benefit from the GLP-1 boom and aging population trends in the next years. In our view, the obesity market represents one of the most important growth opportunities in biopharma due to the breakthrough GLP-1 therapies and also rising global obesity rates. The company's existing GLP-1 drugs, Mounjaro and Zepbound, are seeing exceptional growth so far. In Q2, sales of Zepbound rose by a record 172%, and Mounjaro sales rose by 68%. So these two products now account for nearly half of Eli Lilly's total revenue, and we expect this fast growth pace to continue. We also think Eli Lilly's focus on innovation continues to be a key differentiator versus peers. The company has two promising R&D assets, orforglipron and bimagrumab, which can reinforce its position in the fast-growing obesity treatment markets. Eli Lilly plans to submit a regulatory application for the daily oral GLP-1 pill orforglipron by year-end, which we think could be a game changer due to its convenience to use. We think orforglipron could be the next major catalyst for Eli Lilly and a key revenue driver. We think the pill could start to make meaningful contribution to Eli Lilly's results starting in 2027. We also expect sales from Kisunla, Eli Lilly's early Alzheimer's disease treatment, to ramp up quickly, especially after its recent approvals in key international markets such as the EU, Japan, Great Britain, and China. So the company will announce its Q3 results this week on Thursday, and we expect another robust quarter. We believe Eli Lilly can sustain superior revenue growth versus peers through 2026. We continue to see strong growth prospects for the company thanks to its diversified portfolio of strong brands. We also think Eli Lilly's recent announcements for large investments to onshore its manufacturing is the right strategic decision in the current environment.
Okay, it sounds like it's positioned itself in a good spot.
That's correct.
Okay, let's move on to Merck, and you're liking this one as well. It's going at $98, and it's I think it was off slightly. They're all kind of having an off day right now, but it's off slightly right now. But what do you like about Merck?
So we have long-term views. Our recommendations are at least 1 year or longer. That's why it's good to have a long-term perspective when looking at these recommendations. We have a buy opinion on shares of Merck. And as you may know, the company is best known for its biologic immuno-oncology therapy, Keytruda, which has quickly become a top treatment option for cancer. As you just said, our price target is $98, and we think shares are trading at a discount to Merck's 5-year historical forward P average and are quite attractive at current valuations, trading at a 3-year low. So we expect the key oncology drug Keytruda to remain the top-selling drug globally the next years. The company has a long-standing strategy of expanding the indications of Keytruda into the more lucrative first-line treatment setting where more prescriptions are written, and also into cancers with the largest populations. So until 2028, when Keytruda will hit its loss of exclusivity, we think the drug will make around 50% of Merck's total revenue. We also see strength in Merck's cardiology and the rest of its oncology portfolios, and we think that the exposure to animal health offers good diversification versus peers. This is roughly 10% of Merck's total sales, and we expect animal health segment sales to grow faster during 2025 and 2026. We also welcome Merck's successful portfolio diversification strategy, which we think is advancing quite well with the recently closed $10 billion acquisition of Verona Pharma. We think the acquisition will strengthen Merck's growing cardiopulmonary portfolio. So the company is also announcing its Q3 earnings on Thursday morning, which we will closely follow.
I have to. The animal health one interests me. That they're branching into that. There's that much money in it, is there?
Definitely. So we think it's a very niche part of healthcare right now. And we think that because of this trend that we are seeing, where like pet owners are treating their companion animals like a family member, there's like a really growing interest in companion animal healthcare, which we think is one of the long-term trends that the company is going to profit from. And the company also has livestock segment, which we think is also a segment that is promising when you look long-term.
Okay, and last but not least, Johnson & Johnson, a classic.
Yes, so we recently raised our opinion on shares of Johnson & Johnson to buy from hold after the company reported solid Q2 results and announced the separation of its orthopedics business, which is currently under its medtech segment. Our target price is now $220, which we lifted from $166 per share. So we think the Q3 results topped estimates. We think Johnson & Johnson delivered a very solid Q3 performance, with sales reaching $24 billion, up nearly 7% year on year, which was above the level we saw in Q2 at 5.8%. And looking at the segments, the core innovative medicine sales increased by nearly 7%, powered by the robust oncology franchise, particularly key drugs, Darzalex and Carvykti, which, in our opinion, counterbalanced ongoing headwind from the key immunology drug Stelara, which is facing intensifying biosimilar competition. Also looking ahead, we think the innovative medicine segment offers a promising long-term outlook due to strong prospects for its key existing drugs, but also the new recent launches. While we expect ongoing sales erosion in Stelara to accelerate in the next quarter due to the entry of biosimilars in the US, we think solid growth in key pharma products and also contributions from M&A could help counterbalance this negative impact.
Okay.
Also,
you sneak in one last point. Go for it.
Yes, we also think that the decision to separate the orthopedics business was a very good decision. I think it goes well with the company's strategy of portfolio optimization. And we also think that with this move, Johnson & Johnson should be able to better focus on the higher growth areas of its medtech segment, such as cardiovascular, surgery, and vision.
Okay. Thank you for all that, Sel. We appreciate it. Have a great day.
Thank you.
Sel Hardy is a senior equity research analyst at CFRA.